Hello and welcome to the Business Standard Morning Show. I am Ruchika Chitravanshi and let us take a look at the stories for today. Thanks to aggressive buying by private players, wheat exports from India shot up by 116% in the first 5 months of the current financial year. Meanwhile, India's own stocks of food grains saw a decline and procurement fell by 57%. The wheat stocks with the Food Corporation of India stand at a 6-year low now, slightly above the minimum prescribed buffer. So what is the likely road ahead? Will India turn into a net wheat importer now, just months after promising to feed the world? Let us find out in the next segment.
India's march towards self-reliance has been a long and arduous one. In the mid-1960s, food grain shortage had prompted the then Prime Minister Lal Bahadur Shastri to ask the people of the country to skip a meal every week. Drought had ravaged the country 2 years running in 1966 and 67, and India imported its highest ever quantity of wheat under PL 480 that year. It was 10 million tons. But the Green Revolution and several other schemes made India self-reliant in food production. So earlier this year, when the world was staring at a wheat shortage due to the Russia-Ukraine war, India was expected to rise to the occasion. Its wheat exports doubled in the first 5 months of the ongoing financial year. But extreme weather played spoilsport. Wheat production dipped, and so did its procurement. According to Food Corporation of India data, at 22.75 million tons, wheat stocks in public godowns on the 1st of October were at a 6-year low and just above the minimum buffer requirement of 20.52 million tons for that date. Meanwhile, at 28.39 million tons, rice stocks, including grain derived from unmilled paddy, stood at nearly 2.8 times the minimum buffer of 10.25 million tons. Overall, wheat and rice stocks with government agencies stood at 51.14 million tons as on the 1st of October. Not only did this represent a 37% decline from the 81.6 million tons in stocks a year ago, it was also the lowest level for the same date since 2017. The fall coincides with the consumer price index based inflation for the month of September surging to a 5-month high of 7.4%, largely due to a spike in food inflation, which jumped to a 22-month high of 8.6% for the same period. Meanwhile, the consumer price index for cereals and products rose 11.53% year-on-year in September, representing the highest ever annual inflation for cereals according to the current price index. While the overall cereal stocks position appears to be relatively comfortable for now, thanks to the rice stocks, things could change going ahead due to persistently high inflation. With regard to non-PDS wheat and atta flour, annual retail inflation hit an all-time high of 17.41% in September. Market players and traders hope that the prices of agri-commodities will soften as the arrival of Kharif crop peaks in the weeks ahead. However, the decline in prices could be limited when it comes to cereals because of the low stocks in government godowns and damage to the standing harvest due to the late withdrawal of the southwest monsoon. A decline in prices is also improbable because the next wheat crop will hit the markets after mid-March next year. Thus, the declining stocks of the food grain could become a cause for concern. In the open market, wheat prices have largely stayed above the minimum support price or MSP of 2015 rupees per quintal this year. There are two reasons for this. First, there has been a drop in production because of a rise in temperatures during the crucial harvest months of March and April this year. The second one is favorable demand. Meanwhile, the Russian invasion of Ukraine has pushed up global wheat demand, which has caused a price spike in Indian markets. Owing to this sharp jump in prices and a massive drop in procurement, the centre in May imposed a ban on exports. However, that did little to cool prices, and the markets have been trading above the MSP due to the fact that there are no pipeline stocks with flour millers. The drop in procurement has also limited the centre's ability to intervene in domestic wheat markets to cool prices through open sales. Meanwhile, despite a slowdown in exports after the sudden mid-May ban, India exported 4.35 million tons of wheat during April-August this year, amounting to a 116.7% increase compared to the corresponding months last year. Exports of the food grain received a boost after demand for Indian wheat saw a major jump due to the Russian invasion of Ukraine in late February. According to reports, India was a net importer of wheat in 2016-17 and 2017-18. However, most of these imports were of high-quality wheat meant for millers in the south that found imports to be more economical than buying from the domestic market. Coming to the present, will India become a net importer of wheat to ensure food security?
Primarily because your wheat procurement in the current financial year, that is FY 22-23, is almost 57% down than last year. Now, what happens if the prices move up? Now, by January or by December end, if the prices move up further and the inflation does not come under control, government will be forced to import wheat. Now, this wheat, mind it, won't be in the government account. There are two options to it. Either government imports on its own account or let private traders import and then sell the wheat in the market. Now, private traders will only import if the prices are favorable in the international markets compared to what is in the domestic market. As of now, international wheat price, landed price of international wheat in the Indian market, Indian ports is roughly around 31 to 32 rupees a kg. The maximum price in which Indian wheat is selling in southern ports is around 27 to 28 rupees a kg. To become a net importer, India's import of wheat has to be more than the export. So this year, India is expected to export around 4.5 million tons of wheat, which is before the ban was imposed on May 14. Now, will the import be more than that? Doesn't look like. As of now, the market conditions, the market talk is that the government, if it will lower the import duty, let private traders import wheat, and the maximum wheat that will be imported in the southern ports is roughly around 1 to 1.5 million tons, which will be good enough to cool down the prices for the time being. But the government also, the point here to be noted is that the food secretary in a press meet which was held today very categorically said that they have enough amount of wheat to intervene in the market.
International prices will depend on the fate of Ukrainian wheat being controlled by Russia. If this wheat comes into the market regularly, prices may soften to some extent. If India does find itself in a position where it needs to go to the international market to meet its domestic needs, it will find the task all the more challenging if the war continues and there are any future restrictions on this supply.
Almost all the countries of the world are scrambling for ways to prop up their economies. Central banks are raising rates to suck liquidity and bring down the soaring inflation. And banks too are passing on the rates. Amid all this, where should you park your hard-earned money? Our next segment has the answer. Soaring inflation nudged India's central bank, the Reserve Bank of India, to put an end to the low interest rate regime. A series of repo rate hikes by RBI made fixed deposits lucrative, bringing it under investors' radar. Starting with the off-cycle hike in May, RBI has hiked the key lending rate, the rate at which central bank lends money to banks, by a total of 190 basis points to 5.9%. Although banks have increased deposit rates across various tenures, the transmission has been either slow or not kept up pace with repo rate hike. For instance, till early August, while the repo rate was hiked by 140 basis points, banks raised deposit rates by just 30 to 60 basis points. Since then, the pace has picked up. Banks have increased fixed deposit rates by 30 to 50 basis points, and some of them have also announced special deposit schemes offering over 6% interest on some tenure FDs. The quantum of deposit rate hikes usually depends on the credit demand and the liquidity surplus available. According to the RBI data, in September, Demand for bank loans is at 9-year high of 16.2%, with loan demand picking up in the festival season and surplus liquidity coming down from the highs of 8 trillion rupees in early April 2022. Experts see bank deposit rates rising further. Currently, the deposit rates offered by private banks are in the range of 5.45% to 7% for 1-year tenure. And public sector banks are offering interest rates in the range of 5.5 to 5.7% for the same tenure. The rise in deposit rates also comes at a time when global headwinds have dented returns in other asset classes such as equities. Both Nifty and Sensex indices have slipped over 2% this year. But despite the fall, Indian markets outperformed their peers. The MSCI Emerging Market Index is down almost 30% this year. What analysts suggest: equities 40 to 50% allocation, fixed income 20%, rest in gold or real estate. According to a Business Standard report, equities are still the most favored choice of analysts. They recommend 40 to 50% allocation to equities, 20% to fixed income, and the rest can be kept for gold or real estate. Gold has declined about 7%, while silver is down about 17% in the last 1 year. Meanwhile, 10-year government bonds have added 96 basis points so far this year. Experts suggest investors should look at fixed income options like deposits only as a part of their portfolio and avoid excessive reliance. Also, it is best to opt for shorter tenures given the likelihood of interest rates going up further. This can be done to park emergency funds or to protect the capital to some extent. Deposits are unlikely to beat inflation in the longer run, and hence experts suggest a balance in allocations by investing in fixed income and growth assets. Just like it is very difficult to call the top and bottom in an equity asset, the same goes with rates on fixed deposits. Additionally, with interest rates on the upswing, yields to maturity of debt MF portfolios have improved and are in the range of 7 to 7.5%. In the fixed income segment, experts say investors might also want to consider this option. Debt mutual fund schemes invest in fixed income securities like government bonds. Investors who are in the lower tax bracket and looking for liquidity would find FDs as a good option. For investors in higher tax brackets, debt mutual funds could be a superior option because of the index ratio benefit they end up getting. Let us hear more from Harsha Chetanwala, a financial planner.
One is that the interest rates have already started increasing. Okay, and typically what happens is in a scenario where the interest rate starts increasing or it has already started increasing, it is better to start locking your investments in a longer period of time when you see that the interest rates have somewhere stabilized. What I mean by stabilized is the interest rates have already reached or around the peak. At this stage, while we all are aware about that there could be some more increase in the interest rate, it is better to look at medium duration or mid-term kind of a fixed deposits rather than locking it completely into a longer duration deposit. When it comes to investments into fixed deposit, we have to keep in mind that fixed deposits is a part of our overall portfolio and asset allocation. Predominantly, fixed deposits has to be used for your contingency or parking your money which you may need during the emergency. Because we all know the interest rates offered by the fixed deposit, even though we take a mid duration or a longer duration, it's still very it may not beat inflation, or it may be very close to inflation. Okay. Now, considering all these things, one have to be very clear that when you park money into fixed deposit, particularly from a longer duration perspective, that's the risk that we all carry by keeping more than required money in the fixed deposit.
Within the fixed deposits, there are corporate and NBFC FDs. According to data from Paisabazaar, small finance banks and NBFCs are offering the highest fixed deposit interest rates, followed by PSU banks and large private sector banks. If we look at interest rates offered by Bajaj Finance, investors can get 6.35% for 1-year tenure, 7.4% for 3-year tenure. Comparatively, private lender Axis Bank for the same tenures is offering 5.45% and 5.70%. On the other hand,
Public sector lender Bank of Baroda is giving 5.5% interest rate for 1-year tenure and 5.55% for a 3-year tenure. Both the private and public banks' interest rates on fixed deposit rates are lower compared with the NBFC of Bajaj Finance. The penalty period for NBFCs is also lower compared with banks. Even though NBFC FDs offer higher rates of interest, banks are traditionally considered safer as deposits of up to 5 lakh rupees are covered under deposit insurance scheme in case the bank goes bust. This is not the case with corporate or NBFC FDs. Investors can also claim deductions of up to 1.5 lakh rupees in a financial year under Section 80C of the Income Tax Act for 5-year tenure deposit. When choosing corporate or NBFC FDs, experts say the liquidity and credit rating of the companies is key. Rating agencies like ICRA and CRISIL provide safety ratings to the deposits of corporates. For example, Bajaj Finance fixed deposit has the highest stability ratings AAA/stable from CRISIL. However, credit rating is not the only factor to consider, but investors should also look at other parameters like profitability of the company or NBFC, the non-performing asset ratio, etc. Overall, experts suggest fixed income investments like fixed deposits to only protect capital, and portfolios should be balanced with growth asset investments to generate higher returns.
Given the volatility, one should tread cautiously on the Lal Street. Though there have been stock-specific wealth creators, the overall scenario wasn't that good this year. Andrew Holland, CEO of Avendus Capital Public Markets Alternate Strategies, spoke to Business Standard's Puneet Wadhwa on the opportunities and pitfalls investors should be mindful of in Samvat 2079.
Hello and welcome to the show. I'm Puneet Wadhwa and we have with us Andrew Holland, CEO Avendus Capital Public Markets Alternate Strategies.
Good morning and thank you for this opportunity, Puneet. Always a pleasure.
The market in terms of the headline numbers of the frontline indices hasn't done much this year. However, there have been stock-specific stories. So is that how the markets will be in the foreseeable future according to you?
Possibly. I think this divergence in kind of sectors and companies is the usual divergence you get anyway when you're going through some headwinds. But I think going forward is what's the themes going to be in 2023. Now, obviously, one big theme will be when does the central banks, particularly the Fed, put a hold on interest rates. Right, so that's going to be one theme, and that will play out. But the bigger theme in terms of where you're going to get, and that obviously you can look at that and say, okay, the banking sector would do well with interest rates on hold and so forth and so on. But what will be the other themes that play out? And we still think that 2023 will be start of a big corporate capex cycle and government capex cycle globally. And it's going to be in those areas which we probably know already, like defense, renewable energy. But I think the big factor that will play out will be capex by either governments or corporates, or a combination of industries where there's been a supply chain security problem, or you want to diversify away from China. So semiconductors would be one example for India. But that's going to be prevalent throughout the kind of capex cycle globally. So when you look at capex, you usually think in India it's the normal roads, bridges, and so forth. But I think this time it will be slightly different in terms of where you should be looking. So will it be the smart factories, the smart buildings, whatever it might be? Who's best prepared? Is it the kind of ABB, Siemens of this world who would capture that, rather than the kind of normal L&Ts and BHELs on the pure kind of roads and bridges and so forth. So I think that's going to be a new theme that plays out. And I think the other theme which will play out beneath is that we all know that there's safeguards now surrounding China imports. I think the electronics industry in India is going to boom. Now there's a lot of companies, not so many large caps, a lot of mid caps, and I think that's where to focus energy and attention in terms of finding some of those winners going forward.
Is there any silver lining in store for the markets in the next Samvat? I mean, the Indian markets as well as the global market. And in the Indian context, what are the key themes or sectors you are working with where investors could park their money?
So I think if I was to make a kind of a prediction, which is always fraught with danger at the moment, Puneet, I would say this. I would say for sure that the Fed and other central banks will go on hold. I just don't know the exact timing of that. It could be after this November, it could be December, but I think going into 2023, they will go on hold. Okay. Now, the next question is, when will they pivot? When will they start to say, okay, interest rates are too high, we need to bring them down? I think that will be on the onset of a recession. And I think that's what's going to happen. So that's the kind of good news, because once that happens, and things will be priced into markets. And when you're looking at the growth, then India will stand out, globally as it is today. And investors will come and put money towards emerging markets, and India will be obviously a big portion of that. Now, why am I saying emerging markets? Because I think also if we're going to that pivot, okay, then the dollar will weaken at some point. And therefore, emerging markets, I think, would be the place which you're going to get growth and you're going to get performance. And that's what I think will happen. Now, timing of that is always difficult, but I think that's a 2023 story. And I think how I would play that would be banking and autos and auto parts, because they're a good play on deflation as such, because inflation will start falling as you go into recession. And then those other themes which I talked about, which is capex related, would be the kind of areas, and electronics, I think, will be the themes that play out in 2023.
So what's your advice to the retail investors as we head into the new Samvat?
I think, listen, they've been doing well, right? I mean, they've continued with their SIPs. Yes, okay, they haven't made the returns maybe over the past year, but the markets haven't suffered as badly as other markets. So, I think that kind of consolidation, whether it's a little lower or a little higher, I think is a good base for when the Fed stops raising rates or pivots going forward, for our markets to make that move forward. So I would say continue doing the same. The only thing I would say is, obviously, whenever you're looking at your pool of money, is it's the opportunity cost of being somewhere. So try and look at different asset classes, which will help bring gains over periods of time, maybe not all together. So, for example, you probably would have not made so much money in fixed income in the recent past because of interest rates rising. But if you expect interest rates to fall next year, then obviously that will play out for you going forward.
Thank you, Andrew, so much for your time. We hope to see you again.
Always my pleasure.
Thanks to the GIFT City, which has come up in Ahmedabad, Indians can now invest in international stocks too. And through this special zone, India is also trying to become a global hub for aircraft leasing. But why do most airlines prefer leasing aircraft rather than buying them? And what kind of leasing options do they have? Find out in our next segment.
Airlines prefer to lease aircraft to reduce purchase costs and ramp up capacity at the same time. In aviation, there are two types of leasing arrangements: wet leasing and dry leasing. Wet leasing is an arrangement where the lessor provides an aircraft and the crew too. So here the lessor is responsible for operational maintenance of the flight. In contrast, dry leasing is an arrangement where the lessor offers only an aircraft without crew and ground staff. Here, the lessee will be responsible for the operations of the aircraft. In dry leasing, the aircraft is also operated under the lessee's air operator certificate. Both wet leasing and dry leasing have their pros and cons depending on the requirements of the airlines. Wet leasing is slightly costlier and can increase operational costs for the airline as the lessor provides for maintenance and crew. In dry leasing, the lessee is responsible for training the crew, costs of maintenance, staffing, etc. In this case, the airline will also be in full control of the flying experience. Airlines resort to wet and dry leasing of aircraft in peak seasons to run operations smoothly. According to reports, both Indigo and SpiceJet are planning to wet lease aircraft to increase capacity addition during the winter. As the demand returned after the pandemic, airlines fear losing out market share without additional capacity. According to regulator DGCA rules, wet lease is only permitted in emergency situations for up to 3 months, and the contract is subject to an additional extension of 3 more months. Meanwhile, dry leasing is permitted for up to 12 months, and the contract can be extended for another 12 months.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Apart from wet and dry, there is damp leasing too. In it, the aircraft is leased along with the maintenance and insurance, but the crew is not leased. That's all for today. For more news and analysis, please log on to business-standard.com.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.